Good afternoon, everyone. My name is Marissa, and I will be your host and administrator today. Welcome to the November 2023 First Friday webinar. Today's presentation is titled, What is the Market Missing? In the November 2022 First Friday meeting, we discussed the fact that earnings had increased significantly since the 1980s. Growing earnings increased stock prices at over 10% per year for 40 years, creating record levels of new wealth and an equal amount of hubris. The investing public believed we were in a new era. Then we showed you what the market was missing. In short, it was not human ingenuity or corporate responsibility. 8 months later, in June 2023, the US Federal Reserve issued a white paper outlining this corporate chicanery titled The End of an Era, by Michael Smolyansky, which came to the exact conclusion, which says the next 40 years are unlikely to offer investors similar yields as the last 40 years. We have been focusing on the data and the indicators which are most likely to change the narrative, which is most likely to influence asset values over the next few years. The goal of our discussion today is to understand what future expectations are priced into asset values at current levels, then to determine if those future expectations are reasonable based on actual data, not opinion. Our prepared comments during the session will be recorded, as other families who are unable to attend have asked us for the recording. Please note we will not record your questions, as privacy is always a top priority for our firm. Our prepared remarks today will be approximately 15 minutes long, with some time left over to cover questions from the participants, along with our standard topic, which is, what is the market missing? If you have already sent us your questions, we want to thank you. Your questions truly help us understand what topics are most important to each family we serve. If new questions arise from the content of today's presentation, please either send the question along by typing your question in the chat box at the bottom of your screen, or write it down and raise your hand at the end of the prepared remarks. We will do our best to get to your question at the end of the prepared comments. One final note, please remember to mute your device's microphone and stay on mute unless you have a question, as background noise is audible and distracting. With that said, let me turn the presentation over to Stephen Abernathy, who will provide today's commentary.
Great, welcome. I'm Stephen Abernathy, and this is the November First Friday meeting for our family office members. Today, we're going to bring our quest for reasons supporting an overvalued market to an end. And a lot of you are going to be happy that we're going to kind of end this thing up like this. We're going to show you why the stock market is within 10% of an all-time high, and why the world believes we are not going into a recession, yet raw data tell us we may already be in a recession. So we're going to show you clearly what the market is missing. And while no one knows what will happen once the market comes to grips with what it is missing, we're going to explore, I guess I would say, what's likely to happen when the markets do come to terms with reality. So, slide 2. The government tells us our economy is growing. It tells us we have a 2.5% real growth rate, which is our nominal growth minus inflation. And it tells us we have a 6.5%. Well, it have a 2.5% real growth rate and a 6.5% nominal growth rate, which is the real growth plus inflation. Sorry. While we're never in a place to call the US government down for offering statistics which are misleading at best, we're responsible for looking at as many angles as we can to understand the difference between statistical data and the truth. So, while we believe the United States government's data, let's take a look at a little bit closer look at what's going into that data. Slide 3. This slide shows the amount of the budget deficit as a percentage of the US GDP from 1970 to 2023. As you can see, the US has been running a fairly regular budget deficit since 1970, only registering a budget surplus during the Clinton years. There are two comments we want to make here. Slide 4. First, while the US government may be correct in its claims that the US GDP is growing at 2.5% real growth and 6.5% nominal growth, and while those numbers may provide a sense of comfort for those who choose not to look at the details, for those that do look at the details, they're going to see a very different picture. The United States government is running a deficit of over 7.5%. This means that Uncle Sam, our philanthropic uncle, is donating over 7.5% of our GDP, or our country's revenue, free of charge, just for being a citizen of the United States. And I want each of us to think about this for a moment. And put yourself in this position. If you have a business that's losing 5% of your money each year, yet you have a wealthy uncle who gives you 10% of your revenue each year, is your business really growing at 5% per year? Or is your business losing 5% per year and the money from heaven is just landing in your bank account? Well, the process of that decision defines the valuation of your business. The question, how long will our beneficent uncle continue to ply us with money from heaven? Is this really a good business? Is this a business I really want to buy, understanding that this rich uncle could stop giving us money at any point in the future? Or maybe the uncle runs out of money and the market won't let him give you money anymore. Slide 5. Or is this a better way of looking at this company we call the United States of America? Keep in mind that we're performing this analysis because we're preparing to invest in our US economy, each of us, which is really it's an investment in the United States of America, and the United States economy has a 93% correlation to the earnings. So the S&P 500 has a 93% correlation to the US GDP, or the earnings our US economy generates. What I'm saying is, as the US GDP goes, so goes US earnings, with one slight difference. Each of the companies making up the S&P 500 do not have a rich uncle who's philanthropic, donating 7 or 8% per year to their bottom line. However, you may say, hey, Stephen, listen, we like you and thanks for the effort, yet this is a bit harsh. After all, the government can print money, and it has been running a deficit since as far as the reliable data go. And your statement would be a true statement. The only difference is that today we have over 32 trillion in debt that we didn't have 25 years ago when we ran a deficit. And at some point, the world is just going to say no. They're going to slam on the brakes and tell us they don't want to buy our bonds anymore. Or if they do want to buy our bonds, they'll only buy them if we pay them 8% or maybe 10%, which will lead us to a very uncomfortable future for the United States, defined as default. Slide 6. Let's take a look at the government statistic from a different perspective. Let's use the preferred inflation gauge from the United States Federal Reserve. They call it the super core CPI, and it's running a bit over 4% per year. So let's just use 4% in our simple math here. This chart shows that for much of 2022 and 2023, it was higher, yet 4%, we're just going to settle for a 4% number because it's an easy number to do the math with. Slide 7. If we look at our GDP from the perspective that our country has a rich uncle and that uncle is always going to be around to give us money each year, what does it look like after we take away inflation? This simple slide shows that depending upon how you want to calculate the value of our country, it is either growing at 2.5% or it's shrinking by a bit over 5%. Keep in mind that we're doing this exercise because our GDP is 93% correlated with the S&P 500's earnings. And when our economy's prospects, or when our economy prospers, the S&P 500 is going to prosper. And the other side of that is true as well. When our economy shrinks, it's highly likely that the S&P 500 earnings are going to shrink or actually lose money. The reason most investors should be concerning themselves with this relationship is that the S&P 500 is priced to grow between 10 and 15% per year for the next 5 to 7 years. We went over this last month, but think about this. Our S&P 500 is currently priced at over 21 times earnings, which means that, and it should be priced at around 15 times earnings, which means it has to grow earnings or shrink by a significant amount. Slide 8. If our country is going to grow at less than 2.5% for the next 5 to 7 years, it's quite unlikely that the S&P will do much better. Yet, as you can see from this slide, most of the calculations show that our real economy is actually shrinking, and the data to come will also support that we have headwinds ahead, significant headwinds ahead, and that we may already be in a recession. As this slide shows, depending upon how you'd like to look at it, we're either slightly growing or we're already shrinking. Either way, there's little evidence to support the expectations that the S&P 500 earnings will grow by 10 to 15% for the next 5 to 7 years. Slide 9. As an aside, I wanted to pass along one more quick observation, and this is important. Slide 10. As this slide points out, during the depths of the great financial crisis, that says that during a period in which our global financial system almost completely blew up and threw us into a global depression, our budget deficit was about the same levels today as it was then. Think about that. Or maybe let me say it differently. Today we have a deficit that looks like we're in a global war or a global depression. Yet our capital markets completely ignore the fact that we're running deficits which rival war times, or which completely ignore the question, what will we do if we really go into a recession? What do we have to fall back on? Don't forget, during the great financial crisis, we had earnings multiples of 6 to 9 times earnings, and that was standard across all companies. So at 21 or 22 times earnings, which is our current structure, there's a lot of risk. Not saying it's going to go there. I'm just saying there's a lot of risk. You have to be very confident that we aren't, or that we are going to avoid that outlook. So I'm going to leave each of you to think about the current valuation as opposed to our future valuation given our situation or our financial structure currently. Slide 11. Several months ago, we spent some time going over the differences between signals and noise. The goal was to allow each member of the family office to save time by ignoring the talking heads and the press and the press that's on TV, and just focus on the indicators which offer reliable information on the real future of our economy. One of those indicators was the Index of Leading Economic Indicators, or the LEIs. And while it was pointing to a recession, we've had no recession. What's going on? Is the signal magically becoming noise? So I'm on the verge of losing my credibility here, and I understand that. Of course, just to remind you, nothing in life is foolproof. However, this chart will clearly show you that if we're not in a recession already, we're highly likely to be in one during early 2024 or sooner. This chart clearly shows that once the LEI has been negative for 18 months or more, our US economy has never, I repeat, never avoided a recession. Again, there's always room for a first, yet, as you are going to see, this time is quite unlikely to be the first. You may remember the other signal we discussed, which was the US Federal Reserve tightening or reducing our money supply. And this action throws our economy into a recession almost inevitably. It's almost flawless as well. Here's a slide which goes back to 1950. It shows that the time in which the United States Federal Reserve started raising rates, and it shows when our economy entered a recession. I wanted to include the slide because it allows each of us to understand how likely it is that our economy is unable to avoid a recession in 2024, and to realize that it takes time for the interest rate increases to take effect. So can we go to slide 12? Let's just skip that and go to slide 13. So here's the slide that we've just discussed. It clearly shows that, excuse me, the Federal Reserve has embarked on a tightening of economic conditions 14 times since 1950. 11 of those cycles ended up in a recession or slightly worse. Slide 14. The most frequent question I get is, why haven't the rate increases taken effect in our economy yet? As you can see, history tells us it takes about 24 months or more for the effective rate increases to bite our economy. The amount of months is highly variable, and it's largely dependent on the amount of debt that we have in our economy, certainly along with the maturity of this debt. Because if you took out a loan last month and it's a 5-year loan, now interest rates increase over the course of the next 2 years, you're not forced to refinance yet, but you will be. It'll come. The longer the duration of the debt that's outstanding, the longer it will take the rate increases to affect the economy and to slow the economic activity, of course. The last topic I want to cover for you today is a signal that is coincident with our economic activity. So let's move away from the leading economic signals and let's go to one that's coincident, because I want to show you that the first couple of slides we discussed earlier, that we're showing that we are in a recession. It's just that our rich Uncle Sam is pumping money into the economy. Um, I want to be able to show you that there are other indicators that are telling us we are in a recession. It's called the Institute for Supply Management, the Manufacturing Index, or the ISM Manufacturing Index. And it's responsible for describing somewhere between 40 to 60% of our economic activity, depending upon the period. Slide 15. When the ISM is below 50, it tells us our economy is contracting. When it's above 50, it says the opposite. It says our economy is producing more goods and we're likely expanding due to demand for the goods and associated services. When you take a look at this indicator, let me just show you what it's telling us today. And it's not pleasant. This chart tells us that our manufacturing sector is well below 50 and has been for almost a year. So this supports I'm guessing it supports what I think the outcome was of those first couple of slides. The ISM Manufacturing Index has been negative for 12 months now. It came in at 46.7, down from 49 last month. That's, remember, 50 is equilibrium. Over 50 is growth, and under 50 is recession. This is the 12th month in a row that the ISM Manufacturing Index has been below 50. That's an ominous sign, and it supports our thesis that Uncle Sam is propping up our economy and that without our philanthropic uncle, we would likely be in a recession already. I want to run through these last three slides and then turn it over to questions if there are any, because these slides are just supportive. They're not noise, but they're not official signals. So slide 16. Junk credit bonds are signaling that defaults are beginning. Just understand these are the lowest rated bonds, and this is a chart that shows that they are starting to approach default level. And that's the market telling you this. Slide 17. This chart shows an accurate year-to-date defaults that have already occurred, that are already on the books, they're already being worked out. And as you can see, they are at a recent record level. Slide 18. This chart shows our Warren Buffett indicator. And I'll leave you with a quick question. Are we priced, or the market's priced for headwinds at 70% of overvaluation? So it's a pretty simple question. This is one of the reasons that I've been so defensive during all of our conversations, because I think that there are times that you can comfortably and confidently make investments that are likely to be lower risk and a reasonable reward. This is not one of those times. When the markets are 70% overvalued, the Fed is tightening, the indicators are telling you we're moving into a recession, and we have wars on two continents with a third, the thunderstorms on the third. It is a time to be cautious, I believe. So the last chart the Buffett indicator. It's a reminder for those who still think the market can grow at 10 to 15% or more for the next 5 to 7 years. If you do, then I guess you can invest at these levels, but I wouldn't advise it. With that said, let me stop and turn this back over to Marissa to find out if there have been any questions in the interim.
Thanks, Stephen. No questions have been entered in the chat yet.
Great. Okay, thanks, Marissa. Thanks for helping us out today and for emceeing this call. If there are any questions that are follow-ups from this commentary, please give me a call, 212-293-3469. Thanks.
Okay, of course. Thank you. Have a great rest of your day.